Hey folks, good afternoon. This is your host Mandeep. It's Sunday, March the 15th, and I'm going to do another tutorial today. And what we will do in this tutorial is we will look at the levels where the market may find potential support, and and also look at some additional levels where the market could go to. Right, just because the market has dropped 25% doesn't mean the correction in essence has ended. This could continue for a fairly long time. And then I want to share with you one of the most reliable indicators that can foretell a change in the market direction. So this is something that I shared with a number of people in my Discord room, and this is pretty much to the dot. You can determine the exact point within like 15 to 30 minutes. You will see the change in direction. I'm going to show you that, and I'm also going to show that in perspective of the history as well. What happened in the past when that indicator went above a certain level, and then it also will help you determine sort of a safe zone of when to get back into the stocks as well. So let's get into it. And the first thing we'll do is we'll take a look at the monthly chart on the SPX, right? And what most technicians have been doing is they've actually drawn the trend line, which basically starts from the Feb 2009 low, to the current level. So what you do is, you just take, this as the starting point, and what we'll do is we'll, draw the trend line here. And magically, as you can see, we stopped right at this trend line, and that's for now. We can also turn this into a channel. So the way to turn this into a channel is by right clicking, and you can say redraw this as a channel, and you can mark this as, you can redraw this as a channel. So one of the things you notice is that for most part the SPX has stayed in this uptrend channel, which is your let's call it the dominant channel, your long-term trend, and it has respected these levels here, 1, 2, 3, and now sort of the fourth place where it has stopped. Now, does that mean this is the end and the market will keep continuing? Well, the answer is nobody knows, right? So only time will tell. But it certainly is not all clear from my perspective, and I'll show you another indicator that you will find extremely reliable. So what the now what we'll do is we'll take a look at what are the potential levels where the market could go to. So one of the other things we can do is we can draw like the fib levels from the highest point to the lowest point. So if we take the fib levels and draw it to the 2009 low, we get the following levels, right? So we get this level, which is 61.8%, which is kind of considered like the golden cross, and that stands at about 2380. And then we have the 50% level, which is 2076. So I'm not saying that the market is going to go down to these levels, but these are levels that you need to keep in mind. Now, the other thing is, if you were aware of these channels, one thing you would do is, when the market is sort of close to these levels or this trend line, you wouldn't be entering anymore. You should have taken off your, short positions and, gone long. And I'll show you another indicator that I have, or a strategy that I've built, which would have gotten you out of that position close to this level as well. Now this is another important level, and this is the low of December 2019. Sorry, December 2018, and this is another level that a lot of people talk about, which is 2373, which is, and certainly within reach where the market could go to. These trend lines, the way to play this trend line is, if it actually breaks this and comes and touches this line, and when you get a rebound and it goes back into the channel, that's usually a safer point to buy the stocks. So this is an important and easy way actually to draw the trend lines, and this should help you in sort of forecasting where the market is going to go, right? And in this case, it's actually worked to the dot. And this is something, I'm not talking in hindsight, but if you go to my to the board on stock twitch.com where I post charts. I had actually posted this even earlier when it had actually dropped to this level. That's one thing. Okay. The second thing I want to focus on is the indicator that I talked about, and it's not something that's paid or anything. It's a free indicator. Anybody can plot it on Thinkorswim, which is very reliable. So now, if you look at, let's just go and take a look at the market on a 30-minute time frame and see where about is the point where the market started to drop. So this is about this is 221, and this is the Friday, and then that the next day is, which was the following Monday, is when the market actually started to go in a downtrend, right? So what we're going to do is we're going to take a look at a product called VIX, which most of you know, which basically, in simple layman's term, measures the risk in the market, right? It's looking at the volatility of the SPX products and measuring what the risk is. Now, in most cases, the VIX is measured for 30 days, 60 days, 90 days, and, there's future contracts on the VIX products. In general, right, the higher, the near-term volatility is going to be lower than the higher-term volatility. So in other words, think of it this way. There's, your risk is more known at the current time versus like 3 months out, right? So you're more certain of your job right now than, what would happen like 3 months out. Now, time happens when this VIX gets inverted, right? Or commonly it's called a backwardation mode, where the near-term VIX becomes more expensive than the VIX that is 3 months out. And when that happens, that ratio is going to flip, and I'll show you. So the simple way of plotting it is you go VIX and you compare that with VIX 3M, right? So 3 months out, right? And one of the things that you could do, and I'll do it from scratch so you can see it. So let's apply. This is what you get. So now you go into this and you can add what's called a pair ratio study, right? So take the pair ratio, add, and then you don't need to adjust anything. I just leave it at this level and hit OK. And so we'll take a look at this ratio right now. Adjust the chart a little bit. Here you go. So one of the things you'll notice is this is the date. This is now the Friday, which is 221, and this is the Monday, right? So on this Monday is when this VIX ratio went beyond 1. And once this ratio goes above 1, the volatility is going to expand. It's just going to go into a higher volatility mode. And, this basically foretells a change in the direction of the market. Now, as you can see, for a lot of months prior to that, we traded well below zero, and in most cases, it may come very close to zero and then, quickly revert back. Now, you can change this and look at it from, a weekly standpoint, and it'll give you all the times in the past where this thing is actually hovered above 1, and all of these times are times where the market is actually gone into a little bit of a downward spiral, right? But in this case, it is elevated and it has stayed above 1 for a significant period of time. So if you were to take sort of my word on it, and you can just plot this and keep it handy and wait for a time when this ratio starts to drop below 1, right? When it drops below 1, it's a fairly safe zone to re-enter the market again, and the market would have bottomed or come to, would be generally a safer place to take your bets. This is not like a safe place to bottom fish, because you do not know at this level how much more the market will go down. Okay, so this is the most important thing that I wanted to share with you in this video. And so this is very easy to plot. You do the VIX minus VIX 3M, and then all you have to do is add the study called the pair ratio, and you'll be able to actually plot this and see it for yourself. Now, the third thing I'm going to do is, I'm going to get rid of this study, and I'm going to show you one other thing. I'm going to apply the study or the strategy that I've developed, which is the UTS day trading strategy, UTS day trading and swing trading strategy. Okay. So I'm going to add that study here, and I'll leave it everything to the default value. And what we're going to do is we'll just switch to the SPY, and maybe we'll just go to the 4-hour time frame on this. We could go to a higher time frame as well, but let's just switch to the 4-hour time frame. And so let's just go back, a couple days and see where the market really started to, uh, you know, take a fall, right? So this is your date of 212, right? So basically, if you were in this signal or using this strategy, you were actually out of the market at this point, which is 337, which is pretty close to the highest point here in the market, right? Now, as the market starts to go down, right now, this date is 224, right, which is not which is the Monday following the Friday, when the market really went into a downward spiral. The ultimate trading strategy entered a short signal, and so now in the worst of the markets, right, this is clearly one of the worst markets that people have seen, the biggest downtrend that has happened. We got this one trade and we got another trade. And all of this can be looked at by just clicking on show report and looking what the performance has been, right? So obviously the total profit loss was like 32 trades, you made $7,400. But look at what happened from 3.2 to 3.13. It had two trades of 2,600 and 3,800, right? So that's almost like $6,500 in profit in just 15 days, right? And the fact that you're not exposed to long positions, because once this happened, I was more or less sort of flat across my accounts, right, including my 401k account, and I haven't re-entered much except playing a little bit day trading on sort of on the short side and swing trading on the SPY. So these are couple of things that could have helped you. So my apologies, the video got cut off at the end, and I wanted to wrap it up by just sharing that if you were using this strategy, it gave you these two trades. You got a sell signal here, you took 100 shares short and you covered it here, and then you had another opportunity of taking another 100 shares short and covering it here. Now, at this stage, I'm not either long or short in the market. I am fairly flat, even though the market ramped up significantly end of Friday, and almost going up 100 points in the ES futures within about 10 or 15 minutes. I'm perfectly okay for going that profit and seeing how the market reacts in the coming week, right? So once the futures open, how they react, and what do the Asian markets and what do the European markets do, that'll tell us how the US markets are going to trade tomorrow morning, right? So just by using a couple of these indicators, you have a pretty good sense of whether you want to be on the long side or the short side of the market, and hopefully some of these levels helped. And more importantly, I hope the indicator that I talked about, where we look at the ratio of VIX to VIX 3M, that helps you sort of forecast where the market is going to go and when is it a safe time to re-enter the trades. So one of the things I inadvertently talked about was a level. It's level 0. It's not level 0, but we're talking about the VIX ratio, VIX to VIX 3M going above level 1, right? The value is 1, not 0. So above 1, it goes into a backwardation mode, and below 1 is sort of a safe zone. So hopefully, you guys stay safe and enjoy your trading. I'll talk to you soon. Bye-bye.